Hello and welcome. Today we're going to cover a little more market terminology and why it's important to you as an investor. And after that, I'm going to tell you what you need to do to get started and how you can begin putting all of this information to good use to become a better investor. If you're new to this channel, I would like to welcome you and invite you to subscribe. Also, while you're at it, go ahead and smash that notification bell so that you will be informed when a new video is published. I encourage you to also leave your comments, good or bad. Give this video a thumbs up if you like it or a thumbs down if you don't. All feedback is very much appreciated. So today I want to talk about some of the things that can make the market, or at least some stocks in the market, move up or down. As an investor, you will come to understand that sometimes there's a very logical reason why stocks move in a certain direction. You will also sometimes see the market move in one direction or the other for what seems like no logical reason at all. Understanding what some of these drivers are can make you a better investor and can help keep you from panic selling or panic buying. As you become more knowledgeable, you will start to develop your own investment strategy. So let's start with what is commonly referred to as earnings season. In the previous video, I talked about earnings per share and shares outstanding. I also talked about how these two components are used to calculate other values that are used to measure a stock's performance. If you haven't already watched the first 3 parts of this series on stock market basics, you're going to want to do that so that you can put all of this information together to help you see the big picture. Now, when you hear the term earnings seasons, what they're referring to is the months of the year during which most quarterly corporate earnings are released to the public. Earnings season generally occurs in the months immediately following the end of each fiscal quarter. This means that earnings seasons typically fall in January, where companies will report their earnings for October, November, and December of the previous year. In April, when they report their earnings for January, February, and March. July and October, with each reporting earnings from the previous 3 months. There are also some companies that report earnings outside these months, but for the most part, these are the months when most companies report their earnings. You should also know that corporations also forecast their earnings ahead of time for the next quarter. This is why earnings season can be very important to you as an investor. You want to know if the company you're invested in or thinking about investing in actually earned what they said they were going to earn in the previous quarter. You also want to know what their outlook for the future looks like. There's no official end to the earnings season, but it is considered to be over when most major companies have released their quarterly earnings reports. Generally speaking, it lasts for about 6 weeks after the start of the new quarter. So here's what you need to know and understand about earnings season. Wall Street, which is a term sometimes used to represent all investors, doesn't like it when companies fall short of their projected earnings. If a company has forecasted that they will earn, say, 46 cents a share, and it only earns 45 cents a share, that's not too bad, although you may still see the stock price drop slightly because of this. But if that same company forecasted 46 cents a share and they only earned 40 cents a share, that's a big deal, and you will likely see the stock price take a bigger hit. Sometimes companies do better than what they forecasted, and this can have the opposite effect on the stock price. If that same company forecasted 46 cents a share earnings and they actually earned 48 cents a share, investors may see this as a sign that the company is in a stronger position than expected, and you will usually see the stock price move up after the announcement. Now, please understand that none of these things are absolute, and sometimes companies will also issue what is referred to as guidance when they forecast their earnings. Guidance usually means that their forecast is contingent upon some currently unknown factors. A hotel chain, for instance, may say that they are forecasting 46 cents a share, but that is assuming travel restrictions will be lifted, for instance. Something else that can move the price of stocks in one direction or the other is new or canceled contracts. For instance, when Boeing was having trouble with its new 737 MAX aircraft, the plane was grounded after 2 horrific crashes, and airlines around the world started canceling their orders for the new planes. During that time, Boeing's stock price fell. The flip side of that is when you hear that our government has increased its defense budget, companies like Boeing or others will likely get new government contracts, which will increase their revenue, which will likely increase their earnings, which will likely increase their stock price. Another thing that can influence the price of stocks is the amount of institutional investors that have a particular stock in its mix of investments. Institutional investors trade in large volumes, and this can drive a stock price up or down. When a stock that has not had many institutional investors all of a sudden starts to attract their attention, it can really boost the stock's price, especially if it's a rather small company. It could signal the beginning of a large run-up in that stock's price. For some companies, a change in stock price could be tied to a new product or service. Whenever Apple comes out with a new iPhone, you will usually see a bump in its stock price. Now, whether that bump in stock price sticks or not is somewhat dependent on how that new iPhone is received by consumers. But that all goes back to earnings. If the new iPhone sells well and earnings go up, investors will view that as a positive sign and buy more Apple stock, which will in turn drive up the stock price. 2 other stock market drivers that I want to touch on briefly are the housing market and unemployment. Let's look at the housing market first. When new homes are being built and sold, it is usually good for the stock market as a whole. That's because the housing market touches so many other areas of the stock market. Think about what all it takes to build, buy, and move into a new home. New home construction requires not only building materials, but there are also machinery and tools that are needed. All of that machinery needs fuel, and all those tools need people who can use them. So the construction of homes employs a lot of people: carpenters, plumbers, electricians, roofers, cement finishers, landscapers, and many others. Then once the home is built, banks enter the picture to offer mortgages. And once the home is built, the new owners will likely be buying new furniture, appliances, window coverings, and other accessories. A strong housing market touches so many areas of our economy and therefore affects many areas of the stock market. Investors also watch the employment numbers. In a strong economy, unemployment rates are usually low. When unemployment rates start to go up, it could mean that businesses are not doing well and they have to lay off workers. Back when the housing market crashed and the government stepped in to bail out banks and other businesses, it wasn't done to save the banks. I know you may have had mixed feelings about that. I mean, why should the government step in and bail out banks when people are losing their homes, right? Well, it was because there are so many things tied to the housing market, including jobs. If banks couldn't make loans, then developers and contractors couldn't build new homes. And if they couldn't build new homes, there would be fewer jobs for those carpenters, electricians, and plumbers and such. And if all those people are out of work, then they don't have money to spend on automobiles, new furniture for their homes. They're not taking vacations, so airlines and hotels suffer. They also aren't buying new tools and equipment, and they are buying less fuel. So as you can see, the housing market is a big driver in our economy. So now that you have all this information about the stock market and some of the things that drive the market, how are you going to put it to use for you? Well, this is what I want you to do. I want you to start by downloading an app on your phone that will keep you up to date with most of the things I've talked about in this series on stock market basics. For you Android users, I recommend you use Yahoo Finance. And for Apple users, I believe the iPhone comes with an app preloaded called Stocks. Both of these apps are very similar and can provide you with up-to-the-minute information on most of the things we've talked about relative to the stock market. They both also allow you to create a watch list of stocks you may be interested in, and both will give you notifications of important stock market news and events. Download one of these apps on your phone and you will always have information at your fingertips as you grow and become a savvy investor. The second thing I want you to do is go ahead and open an investment account with someone like Fidelity or TD Ameritrade or even Robinhood. The type of investment account that you open will depend on your individual circumstances. You might open a traditional IRA account or a Roth IRA account. And while we're on that subject, everyone needs a Roth account. If you need to understand that better, watch my video on why you need a Roth IRA. Or if you don't qualify for a traditional or Roth IRA, you can still open a simple brokerage account, which will allow you to do your investing. I personally utilize all three of these account types. It is important that you take that first step and get that account open. You don't have to worry about making investments right away. For now, just treat it as a savings account and start putting money in it as you can. By having one of these accounts open, it will give you access to other tools that you can use to help you with your investment selections. One of the tools that you will have access to is some type of stock and mutual fund screening tool. There's thousands of stocks to choose from, and trying to find good investments can be nearly impossible without something to help you narrow your search. With the screening tool, you can then plug in some of the things I've talked about, like earnings per share, market cap, and PE ratio, and you can use these tools to find stocks that fit a specific criteria. The stock market may seem complicated and intimidating, but you don't need a PhD in economics to make a lot of money in the stock market. Just look at what those Robinhood investors did. By pooling their resources, they were able to move the market. And in fact, for a short time, they actually ruled the market because their actions had such a ripple effect. You can do this, I promise you. But you have to get off the couch and start taking action. I'm not telling you to just jump in blindly with both feet, but get the app, open the account, and start to wet your toes a little. As you gain more knowledge and understanding, you can wade in a little deeper. In the last few years, I have bought this boat, this Jeep to tow behind my motorhome, and most recently this truck, all paid for with money I made in the stock market. You can have your toys too, or take the vacations you want, or whatever the case may be. But you have to start by changing your financial habits and behaviors. And you know what I always say, change your behaviors and you can change your life. So until next time, behave well.